Good morning, everyone, and welcome to today's webinar. I will be your moderator. My name is Antonella Bona. I am the Region External Communication for Mediterranean and Africa. I'm glad to see many diverse participants today, and we are glad as COFACE to support you with the economic outlook and economic webinar. First of all, thank you for joining us. I'm pleased today to present our today's speaker, Marcos Carias, COFACE economist for Europe and Eurozone, Seltem Igun, COFACE economist for Middle East and Turkey, Dominic Fructer, African economist, and Chaduri Aroni, economist for Sub-Saharan Africa. Before I hand the mic to Marcos, I would like to tell you that there will be a recorded version of this webinar, and also we will send you the presentation at the end of our webinar. We will have at the end of our presentation speaker a session of Q&A that you can submit anytime via question window during the webinar. So please free to send it through the system, and without any ado, I leave the floor to Marcos Carias. Please go ahead.
Thank you, Antonella. So welcome everyone to this webinar on the current economic prospects as we stand in mid-2021. The broad theme of our presentation is that, well, globally, we are in the heat of this recovery from the crisis that was triggered by the COVID-19 pandemic, but that this recovery is not happening quite the same across countries, across sectors. Some pockets of the economy are recovering much faster than others, and what we're going to try to do is to give you a little bit of detail to see where the different speeds, what the different paces of the recovery are in different places of the economy. So first thing we gotta have a look at is vaccination, because as we know, what allows for the recovery is the fact of being able to look out of the pandemic to being able to have an economy without these stop and go dynamics of lockdowns, of restrictions on mobility, restrictions on travel, restrictions of how many people you can have in a store. And here, the first divide that we see is, as you may intuit, between emerging economies and between developed economies, with some exceptions. We know, for instance, that Chile is having a remarkably fast vaccination campaign, but as a general rule, we have some positive outliers: United States, Israel, United Kingdom, that are getting closer and closer to herd immunity, to the extent that life can mostly go back to normal. The economy can mostly go back to normal over there. Europe, where the vaccination campaign was initially pretty slow during the beginning of the year, and this was reflected in GDP figures, but is now quickly picking up pace, and we are increasingly looking to a summer with less and less restrictions, which will be very important for these economies that are very dependent on travel and tourism. On the other hand, as a general rule, we have emerging economies where the vaccination campaign is being slower, and so therefore we are still, to a large extent, in this stop and go logic, where significant restrictions still have to be imposed once we go through episodes where the virus gets out of control, and therefore the recovery is being much delayed. So a positive thing, nonetheless, at the level of the global economy, is that this narrative of we are seeing this narrative of the V-shaped recovery actually materialized in 2021, with a very strong bounce back of the global economy, which at the beginning of the year was being mostly led by the Chinese rebound in manufacturing, in exporting. Now that is the Chinese rebound is slowing down a little bit, and the big story of global growth in 2021 is the rebound of the U.S. economy. So the U.S. economy, boosted by fiscal stimulus, boosted by the rapid vaccination campaign, U.S. consumption is driving global growth. In Europe, the story, as I alluded to before, is initially in 2021 a little bit less optimistic. We see that the more manufacturing-led economies, such as Germany, such as France, are operating broadly at 5% under the level of their pre-pandemic GDP. As we can see on the graph on the left, if we take as a reference the last semester of last quarter of 2019, we still have under 5% activity in the manufacturing-led economies. In the service-led economies, such as Spain and Italy, we're looking more at minus 10%, minus 8% performance in Q1 2021. But as it reopens in the second and third quarter, we can expect the pace to pick up quite significantly. So if you've been following the economic debate recently, you may have noticed that a big theme this year is going to be inflation. And an important thing to keep in mind is that a lot of this chatter that you see in the press about inflation is driven by developments in the United States. Like we said, in the United States, the story of the recovery is much more stronger, much more robust at this beginning of the year that what we're seeing in Europe. Fiscal stimulus approved by the Biden administration is on another order of magnitude versus what is happening in Europe. And more generally, as you can see the graph on the right, inflation is more towards the 5% level and expected to be around that level in 2022. In Europe, we do have fiscal stimulus, we do have a recovery, we do have global commodity prices that are also playing a role in pushing up inflation, but we do not see the same levels, and we don't expect to see the same levels of inflation as the United States. We're expecting maybe inflation to overshoot the ECB target by maybe 1%, which means inflation on the 3% mark. The ECB target, as I might remember, is 2%. But what's important to think about this inflation is that it's expected to be transitory. These inflation developments are essentially being driven by a global demand for goods and services that is recovering at a rhythm that is abnormal, a rhythm that is much faster than supply. And therefore, we see this temporary overshooting of inflation that is expected to stabilize in late 2021, beginning of 2022. Therefore, central banks, their attitude is this. The ECB is considering that this will be transitory. And since monetary policy takes a little bit of time to transmit from the decision of raising interest rates, of cutting down QE, for that to transmit to general prices, that takes a little bit of time. They're saying it's not worth it for us to move monetary policy right now. By the time this transmits to the general price level, we will be past this temporary burst in inflation. And on the other hand, doing that would have the risk of cutting down on the recovery. So obviously, as you may know, commodity prices and commodity price inflation has been a big topic this year. And what I present in this slide are the results of our in-house statistical model for commodity price forecasting on a six-month forecast scenario. And overall, what you see in these graphs are this blue line in the middle that gives you like the central baseline scenario, and what the green and orange lines give you are the range of variation that our model tells us these prices might take. So the overall message is that, especially for agricultural commodities and metals, we expect to see prices that remain essentially high during the rest of 2021. And for oil, we expect that what we have seen so far is mostly an overcorrection from the low levels of 2020, and we expect to see the price of oil converge more towards the 65, $60 a barrel towards the end of the year. When it comes to metal prices, we also have to consider that there are some structural shifts happening there. Most notably, for instance, the structurally higher demand for batteries that are driving up metal prices. Also in China, we've been talking here at COFACE'S for a long time about the overcapacity in the Chinese steel sector being a big factor pushing down metal prices in recent years. That seems to be less and less the case. Overcapacity in China is less and less with the strong strength of the Chinese recovery over there, with the strength of the global construction sector gathering pace. So this has all been very good for metal producers around the world, and certainly in Europe as well. So we expect to see metal prices stay high for longer than, for instance, oil and hydrocarbons. Looking down at what's happening in the sectoral perspective in Southern European economies, we know that the manufacturing sector started recovering earlier towards end of 2020 and has stayed strong in 2021. What we see here are the confidence indicators from the European Commission survey. This is broadly similar, broadly analogous to the better known manufacturing PMI and the services PMI as well. The way to interpret these indicators, I may remind, is that when you are above zero, when you are in the positive territory, it means that a majority of the surveyed businesses in this sector consider that prospects are improving with regards to the previous month. So we are now in a territory where both in manufacturing and crucially in services, confidence has broadly returned to the positive side on both services and manufacturing, both in Spain and Italy, as a result of the increasingly reopening economy. And these positive prospects, we are expecting them to continue all throughout 2021. As always, for everything we say, this is contingent on there not being new variants and the like, there not being any development in the pandemic that makes us go on a stop and go back to a stop and go lockdown kind of scenario. When we go more to the sectoral perspective, same thing. When we open up the box, we notice that there are some sectors that are doing better than others. What you have the sectors on the left, as I say, metals, retail, plastic, wood. These are all sectors that are being pulled by the recovery in manufacturing and construction. They are actually seeing more demand than they are able to meet, and therefore explains a lot of the rising prices and explains a lot of the optimism. Even in the automotive sector, that still is seeing problems, most notably sourcing problems with the semiconductor shortage, with the global shipping container shortage. Demand is becoming strong enough for optimism to return. But especially among weaker parts of the sector, suppliers that depend on the construction of how do you say it, of old kinds of automobiles, engine automobiles. The Bank of Spain, for instance, has been warning a lot about the viability of these kinds of producers, of suppliers, and so you have to watch out a little bit. On the other hand, sectors that are still vulnerable to restrictions, tourism, air transport, accommodation, optimism is not yet back here, and as well as other sectors that still are seeing structural challenges, such as textiles, especially small textile producers, and energy, oil, hydrocarbon producers. We are still seeing problems related to the future decarbonization of the economy. The viability of certain of producers in these sectors is not ensured. The picture is very similar in Italy, where even the manufacturing recovery has been a little bit stronger than Spain, taking place earlier. We see the positive indicators. We see the indicators of confidence becoming positive even earlier than in Spain, and the picture is pretty much the same. Now, I want to finish by talking a little bit about insolvencies, a topic that we've been treating a lot throughout the year. As you know, insolvencies have been remarkably low during the pandemic, mainly as a result of the great remarkable interventions on part of the government through guaranteed loans, through furlough, through bridge aids, to sustain to a very low level of insolvencies. But we are starting to see signs of a catch-up, especially in Spain. We already see business insolvencies in the beginning of the year being above what we had in 2019. But what we have to consider is that governments are still doing a lot to support companies, and even they are looking to do certain things in terms of corporate restructuring, in terms of debt restructuring, in terms of, for instance, modifying the properties of guaranteed loans. In Spain, for instance, they recently announced that maybe they would make the period to reimburse the loan a little bit longer. Maybe they would extend the grace period at the beginning of the loan a little bit longer. All sorts of things that are going to make it easier for companies to manage the debt load, and therefore, to the extent that we see insolvencies increase, we expect to see a less of a huge wave that comes all of a sudden, but more of a gradual managed increase in insolvencies, especially since this is a very political issue. So wrapping it up, keep an eye on the September ECB meeting. Like I said, inflation is not supposed to be an issue. We don't expect it to be an issue, but things might change during the summer, and they will be looking at those indicators. Service sector set for a very strong rebound in second half of 2020. Renewables, information, and tech sector, construction are sectors that are going to see a lot of positive things due to the structurally high demand from European funds, from government subsidies, and insolvencies, as I said, set to pick up most likely starting in 2022, where a lot of the aid from the governments will start to be phased out. So with this, I end, and I leave the floor to my colleague Seltem, who will be focusing on Middle East region. Thank you very much.
Thank you, Marcos. Thank you very much for this interesting presentation. Okay, Seltem, you can go. Thank you very much.
Thank you. So thank you. Focus on the Middle East and Turkey.
You can go on. Now the slides are visible.
Okay.
Thank you very much.
Okay, thank you. So until summer, the COVID-19 cases have been rising across the region, except for the United Arab Emirates and Israel, which introduced a quick vaccination effort since the start of the year. With the decline in new daily cases, the governments have become able to reduce the lockdown measures introduced to counter the spreading of the virus. Well, this has helped the economic activities to be reopened and increase the mobility rates supporting the business activity. Well, Turkey's economy posted a stronger than expected growth in the first quarter at 7% year-on-year and 1.7% quarter-on-quarter, mostly on the back of private consumption, investments, and net exports. As a result, we have revised up our growth forecast for Turkey from 4% to 5.7% for this year, compared with a growth rate of 1.8% last year. Strong retail sales and the rise in industrial output support economic growth in Turkey. Well, despite the tightening of the monetary conditions, yet between April and May, the reintroduction of a complete lockdown weighed on the domestic activity. And with high vaccination rates and the reopening of the economy after 1st of July, we expect the activity to rebound. On the other hand, reopening of the economy in Europe would also add further support to the Turkish economy through external demand channel. We expect net exports to contribute 1.8 percentage point to GDP this year. But it is also important, as you can see in the second chart, it's important to see that contribution of investments to GDP has been positive since the last 3 quarters. And in the first quarter of this year, investments rose 11%, with machinery and equipment investments rising 30%. However, growth in Turkey becomes more volatile since 2015, as the growth model has been mostly based on a large credit expansion, which supports domestic demand. The fact that Turkish manufacturers are dependent on important inputs makes them actually vulnerable to any depreciation of the lira. And with the lira's weakening, 66% since 2015, the inflation rose 100%, putting pressure on purchasing power of households. And you know that the private consumption make 2/3 of GDP, so this creates a huge volatility on the growth performance of the country. We also see a decline in productivity in the country, partly due to the pandemic impact, but also to other problems, such as the low labor participation rates and the low productivity in small companies and etc. But in the upcoming period, with the implementation of some structural reforms, this chart can get better. In line with the tightening of the monetary policy and credit conditions since the start of 2021, there are some preliminary signs about the slowdown in domestic demand in Turkey, which actually we expect to result in a more balanced growth dynamics for Turkey. On a yearly basis, quarterly imports of capital goods slowed to 15% from 31% in the previous quarter, while imports of consumer goods slowed from 22% to 5.6%. Imports of intermediate goods fell 4% from a year earlier. And of course, this slowdown in imports, coupled with the decline in gold imports and slowdown in domestic demand, should contribute to a narrowing in the current account deficit. So we expect the current account deficit to stand between 2 and 3.5% of GDP this year, compared with 5% last year. 12-month current account deficit declined from $36 billion to $32 billion as of April. And 12-month core current account balance, which excludes gold and energy, posted a surplus of $11 billion compared with $7 billion a month earlier. In the rest of the year, thanks to the vaccination efforts in Turkey and also around the world, the number of tourist arrivals is expected to increase. In the first 4 months, Turkey attracted a total of 3.5 million tourists, which is still below 30% below compared with the same period of a year earlier. However, Turkey is now gradually classified in a medium risk category with an increasing number of countries. So the number of tourist arrivals can increase at the end of the year close to 20 million people compared with the official estimation of 30 million. However, there are still some challenges in the Turkish economy, even though the growth become more balanced and the current account deficit narrows. The first one is the inflation that stood at 17% in May, far above the central bank's year-end target of 12.2. The country will continue to face elevated inflation pressures until the last quarter of the year, mainly due to supply side pressures and higher inflation expectations. Import prices also will remain high on increasing commodity prices and the Turkish lira's depreciation. We will revise up our end 2021 average inflation forecast from the current 13.4% to above 50%. In most prices, 13%. May producer price rose 38%, and still it has a way to go because of rising commodity prices. But with the easing of lockdowns measures from June, the demand should allow businesses to continue to pass on cost to consumers. The second challenge is related to the FX reserves of the central bank. Despite some narrowing in the current accounts, Turkey's weak reserves will be headlines for investors. The uncertainty over the central bank's monetary policy keep investors distant from Turkish assets. So the lira currently trades at its record weak levels against US dollar. And the reserves used to meet around 80% of the short-term external debt stock, as you can see in the second chart. But because the burning through reserves to fund its current account deficit, the reserves now covers around 60% of the external debt stock. But with the narrowing of the current account, this is expected to increase. Also, the authorities are trying to pile up the lost forex reserves. However, still further erosion of the reserve buffer, either due to an FX intervention or the current account deficit funding, would put further pressure on the lira. Well, coming to the GCC, we are cautiously more bullish on the economic recovery in the region, thanks to the rise in commodity prices, particularly oil prices. We now expect Saudi Arabia to post a growth rate of 3% compared with 2.7% previously, and Bahrain 3.3% compared with 2.3% previously. The recovery in oil prices will help countries to record higher budget revenues, as they are still mostly dependent on oil revenues. For example, for Saudi Arabia and Kuwait, this is 60%. For Bahrain and Oman, it is around 70%. And for Qatar, it is around 40%. This would, in turn, improve the business environment and improve slightly the payment behaviors of the public sector to the private companies, meaning we can see a better cash flow management in the region for this year. The rise in commodity prices, as you can see in the first chart, has allowed the oil price to climb above most of the GCC countries' fiscal break-even price. Although we do not expect this to allow to loosen the fiscal discipline this year, it would help the economy to record higher gains supported by the vaccination efforts. In the second chart, you can see the performance of the non-oil economy. In the United Arab Emirates, PMI posted 52.3 in May to signal a moderate improvement in business conditions. There are solid expansions in output and new business in May. New orders were particularly helped by improving domestic sales. In Saudi Arabia, the PMI rose for the second month in a row from 55 in April to 56 in May. The reading indicated a robust improvement in business conditions that was the fastest recorded since January. The output increased at a rapid pace in May, supported by a strong rise in new business and in export orders. But as all over the world, the price pressures persist in the region. In the United Arab Emirates, the rate of input price inflation slowed to a 3-month low in May, despite reports of commodity shortages and also rising transportation costs. But in Saudi Arabia, we noticed price pressures are increasing as businesses noted that stronger demand and global supply shortages led to upwards pressure on raw material prices. Before talking about the inflation, just a quick note about Saudi Arabia GDP that fell 3.3% on an annual basis in the first quarter. That was largely driven by the oil sector, which shrunk by 12%. Meanwhile, the non-oil economy grew by 3.3%, and we expect the economy to grow by 3% this year on the back of vaccination and reopening of the economy, and of course, this increase in oil prices. The March 2021 point of sale data showed a pickup in private demand as the number of transactions is increasing. But as earlier said, we expect the fiscal consolidation would weigh on private consumption and investment this year. And coming to the inflation pressures, Saudi Arabia's inflation rate rose for the in May for the second consecutive month to 5.7%. From around 5.3% in April, again reflecting the tripling of value-added tax to 15% last year. So the increase, on the other hand, was mostly due to higher prices of food, beverages, and transport. The headline rate is likely to peak in June, but after July on, we can see a declining trend in inflation as the impact of base effect will fade away. In the United Arab Emirates, we are maintaining our growth forecast of 3.1%. We expect that the growth will be helped by Dubai EXPO and oil prices recovery. Net exports would support growth too. We think that net exports will contribute around 1 percentage point to headline growth this year. Easing OPEC plus supply restrictions will support export growth. And the United Arab Emirates crude oil output volume is estimated to have declined nearly 8% last year. But this year it is expected to increase by 2% as restrictions are lifted. And tourist arrivals would also strengthen this year after plunging 17% last year. Tourism revenues and also tourist arrivals are expected to increase on the back of Dubai Expo, which will be organized with 1-year delay, and it will start on October 1st. But the tourist arrivals are expected to be gradual depending on the vaccination efforts in countries. And although the Expo does not attract 25 million tourist arrivals as estimated originally by the organizers, the country is expected to attract more than 15 million tourist arrivals, which would be nearly 50% above than 2020 and record a tourism revenue of nearly $15 billion. Coming to Israel, just a few words about the GDP. In the first quarter, Israel's GDP unexpectedly contracted by 6.5% on an annual basis, affected by the third lockdown, which began at the end of December and continued into February. Lockdowns hit the private consumption, which contracted by 3.2%, again on an annual basis. But we don't expect this trend to continue, and we are largely optimistic about the Israeli economy. Well, the quick vaccination and the reopening of the economy results in a recovery in the confidence indices, which also support in turn the retail sales, among, of course, other key macro indicators. Investments will continue to benefit from new gas infrastructure projects, and also the government's efforts to unlock new land to build new housing units. The recovery in Israel's key export markets, such as European Union and the United States, will also help the external demand to support economic growth in the country. On the other hand, Israel's new coalition government took power on June 13 after narrowly winning the vote in the parliament, the vote of confidence. The new government includes a variety of different political sections. And even though the new government is only supported by 60 out of 120 members in the parliament, we consider this, the establishment of a new government as a positive step, at least to do a new budget for the country. Israel is still using a prorated version of a base 2019 budget that was ratified in mid-2018. As a result, we have increased our GDP forecast for Israel for 2021 to 5.5% from 5% previously. And this is going to be my last slide, just to give you an idea about the improvements and the changes of our sector risk assessments compared with the last quarter of last year. We are mostly we keep our cautious stance, of course, because we are not done with the pandemic, and this is a big uncertainty still. But we can say that we are now more optimistic about the metal sector, and also the reopenings of the economies can support the dynamics in the retail sector, and we are closely monitoring the situation in agri-food and chemicals, and also the ICT. Thank you so much for your attention. Now I'm going to give the floor to colleague Dominic, who will do his presentation for Africa.
Thank you, Seltem. So we start this presentation on Africa with a chart showing GDP growth for 40 of the 54 countries of the continent. So you have the figures for 2019 in blue, the ones for 2020 in red, and those for 2021 in green. So you can see there is an obvious diversity in growth rates, but for all, there were economic disruptions linked to the COVID-19 and all the lockdowns which were installed to fight against the pandemic. However, if you look on the left-hand side of the graph, some countries were more impacted than others. And that's because of their strong dependence on specific activities which collapsed in the time of the crisis. You have countries first that are very dependent on international tourism and that were very, very impacted. These are Mauritius, Cabo Verde, and two that are not in the chart, but that I can mention too, like Sao Tome and Guinea-Bissau and the Seychelles. You also have countries which are dependent on tourism, but also on manufactured exports to Europe. And this is the case of Tunisia, South Africa, and Morocco. A third category, which was also very much impacted, also depended on tourism, but also on mineral, especially gems, diamonds. And this was the case for Botswana and Namibia. And the last category I would like to stress were countries which were very dependent on oil, and so the oil price collapsed. These were Congo, Algeria, Angola, Cameroon, and Gabon. Of course, these countries are now in recovery phase, but there are two caveats that I would like to add on this, is that some countries are still constrained by structural deficiencies. This is the case for South Africa, Angola, and Congo. And these countries won't see a very vivid recovery because of these structural problems. Also, the countries depend on tourism, will remain dependent on the evolution of the COVID. And you all know that the COVID is not really finished, and that tourism flows are not recovering very well. So those countries depend on tourism will see a very weak recovery. Now, on the other side of the graph, thanks. On the right-hand side, you see that some countries didn't see their growth fall totally in a negative territory. They remained positive. And these countries were mostly those which were dependent on agricultural exports, like Ghana, Cote d'Ivoire, Congo, Kinshasa. And Congo-Kinshasa was a different type. It was dependent on minerals. But these kind of exports were less impacted by the crisis than the others. And also you have some countries which are not very dependent on exports. They rely mostly on their internal activity, household consumption. And this was the case with Ethiopia, Egypt, Uganda, Tanzania, Niger, and Kenya. Next slide, please. This world map showed the cumulated number of COVID cases since the start of the pandemic. And you can see that Africa looks relatively good. And there are several reasons for that. First of all, the fact that the population in Africa is younger than in other continents, and it helps. Also, the fact that urbanization is less pronounced. Of course, there are some big towns in Africa, but they are less than in other parts of the world, like Asia or Western Europe and Northern America. A third reason is that these countries were able to lock down or close their borders relatively early in the pandemic, because they saw what was happening around them. A fourth reason is the fact that they have traditionally less exchange with the outside. And a last one would be that they were, for some of them, accustomed to face other pandemics like Ebola, HIV, or TB. Of course, there were exceptions to that picture. South Africa and neighboring countries, North Africa, Kenya, Ghana, and Senegal, which are countries which are more open to the world. But of course, you have to take into account that in many of these countries, there are statistical deficiencies that relativize what I was just saying. This apparent light impact is valuable for a continent which have only a small proportion of its population vaccinated. Only 2.4% of the population of Africa is vaccinated. And of course, there are some exceptions, but very few, like Morocco, where 25% of the population is vaccinated, and the Seychelles, with 72%. Next slide, please. This chart shows the public debt load for African countries. So you can see on the left-hand side of this chart that some countries have a very heavy debt load. This isn't new, of course, but it was exacerbated by the crisis because of the higher deficits. And I would mention some countries like Sudan, Mozambique, Zambia, Congo, which are in debt distress. Some others are not in debt distress yet, but could fall further down, like Cabo Verde, Angola, Egypt, Tunisia, Mauritius, Zimbabwe, South Africa even. However, the debt load that you are right now seeing on the chart doesn't tell everything, because we have to take other things into consideration to measure the risk of debt distress. First of all, you have to see what's the share of external debt versus domestic debt. Second, you would have to consider the type of currency in which the debt is written. Is it foreign currency or is it local currency? A third factor is that some countries are mostly indebted in a concessional ways, that is, with low interest rates. And I would particularly insist on the weight of debt service. That is what a state is supposed to pay in principles and interest every year, how this debt service measures with public revenues. And also, you have to take into account the support from the international community, multilateral support, especially from IMF or the World Bank, that was extremely important in the crisis. Where was it support usual programs that are sponsored by the IMF, or emergency support? You also have to consider the bilateral support that was installed in the crisis. You may know the Debt Service Suspension Initiative, the DSSI, which 32 countries in Africa subscribed to, and also the common framework that was initiated by the G20 group of countries last fall, to which already 3 countries in Africa subscribed to: Zambia, Chad, and Ethiopia. And last but not the least, you have to take into consideration the access to financial markets. And this will be quite decisive in the coming months for emerging economies. And this is quite important because now we are fearing a rise in interest rates. And so in that case, it will be more difficult for these emerging countries to access in good condition to financial markets. And now I will leave the floor to Aroni Choudhury. We will continue in Africa. Thank you.
Thank you, Dominique. So just moving to the next slide here. So most of the issues that Dominique mentioned also entail the fact that Africa will need to use its resources in order to set their economies back onto the path to sustainable development and growth. And thankfully, Africa is a very resource-rich continent, and the current orientation of commodity prices is favorable to African countries. As you can see on this map, the preponderance of the green color shows you that 46 out of 54 countries of the African continent are classified as commodity exporters as per World Bank criteria. However, exporting commodities does not necessarily mean that those commodity exports are significant for either growth or fiscal revenue or foreign exchange reserves. So in order to pinpoint the countries which really benefit from the aforementioned parameters, we kind of created our own set of thresholds in order to show the significance of these commodity exports on the African continent. Those are materialized by these icons you can see. So obviously there's the category for energy exporters, which is mainly oil, but also light natural gas. There are the minerals exporter, very important in Africa, agro-commodity exporters, and we also added tourism because obviously, tourism is not a commodity per se, but on the African continent, it fills kind of the same role as commodity exports, as I said, as a source of fiscal revenue, of foreign exchange reserves, and also can, in some cases, be the main growth driver, like in Mauritius or Cape Verde, for example. What the map says is actually pretty telling and can be resumed in 3 points. A is that it's not a surprise, most countries in Africa, over 35, do have some kind of commodity export that they will benefit from. And the current orientation of the commodity prices will be very positive for them. However, what it also says is that most of these countries rely on one type of commodity. And that is actually something that increases their risk exposure, because as they rely heavily on that commodity for fiscal revenue and foreign exchange reserves, well, they are also more exposed to price fluctuations. So if these commodity prices start to reverse their increasing trend, well, then these economies will be at risk. And that is exactly what happened during the peak of the crisis. The third point is that there are some countries in Africa where commodity exports are not that significant for growth. Those economies, and as Dominic said before, are more based on their, their domestic economy, or they're not very open to trade, or they're more concentrated around services export, like Uganda or Rwanda, for example, or they heavily rely on tourism, which is obviously not a commodity, but their vulnerability to tourism is quite high. So overall, obviously, the orientation of commodity prices right now is a breath of fresh air for a lot of African economies. Zambia, the two Congos, Angola, Algeria to some extent, and many others. However, the orientation of commodity prices alone will not be enough to ensure sustainable growth on the continent, because commodity-driven growth is not sustainable, and it increases the vulnerability of the economy to external shocks. However, what is important is to be able to use the revenues generated by commodity exports in order to reinvest them to strengthen economic fundamentals and increase the resilience of the economy to shocks. And when you talk about revenue management and resource management, the underlying issue is governance, which brings me to my next point. Speaking of governance in Africa, obviously it is something that has been an issue for decades. As you know, Africa has got a diverse amount of political and security problems. And so, measuring governance can sometimes be a bit tricky because of how varied the number of issues are. However, we made the choice to use our own in-house business environment assessment in order to highlight the issues of governance in Africa. So normally this assessment scales from A1 to E on 8 levels. However, as you can see here on this map, there is no A1 or A2 in Africa, so it starts at A3. And the important point is that 31 out of the 46 countries for which we produce these assessments are at the level of C or lower, and that is generally, C is generally the threshold where we consider that the business environment is difficult, which means that there's weak infrastructure, the institutions are weak, there are problems of transparency, corruption, access to internet, electricity problems, etc., etc. So most of the African continent is actually in a situation where the business environment is very poor, or is poor or very poor, which means that most of the African continent has got lingering issues on governance. The reason why we think that governance is so key and why it is very important to monitor the further developments is because basically it is transversal to all of the points that we mentioned before. You need good governance in order to achieve sustainable growth. You need good governance in order to improve your debt sustainability issues. You need good governance to manage the revenues that you that you're generating through your commodity exports. So monitoring governance is really something that will be very important for the African continent. It is also important to know that on the question of debt, when countries want to enter agreements with the IMF or other multilateral organization, the improvement of governance of the business environment is one of the key factors alongside fiscal consolidation, as well as priority spending in key areas of the economy. So it is really critical for Africa to enable a policy shift towards better governance if they want to get out of this crisis in a sustainable way. I will end on this note by saying that at the peak of the crisis, African governments, public authorities all across the continent did show that they were capable of addressing this crisis in a very strong way, and in a way that is similar to that of other advanced economies in the world. So when the urgent need was there, well, the governments did manage to do what was necessary and used whatever fiscal space they had to implement support policies and to implement lockdowns. And so it shows that there is the opportunity for policy shifts and for improvements in governments. And I think that going ahead, monitoring how these policy shifts are implemented and if they happen will be one of the critical points to see if Africa can return after this crisis to a path of sustainable growth by investing into the key areas of their economy, by economic diversification, by social spending in education, health, and enter obviously agreements with bilateral organizations thanks to these improvements. I will end the part of Africa and the presentation on this. Thank you for listening to us, and I leave the floor to Antonella for the Q&A sessions.
Thank you very much. I hope our guests enjoy the session, and thank you to our economists for this interesting presentation, and also divers that cover all our Mediterranean and African region. Now it's time for your question that you can submit anytime with the question windows. I will start with Seltem. One question. What do you expect from Turkey's central bank as policy step in the rest of the year?
We need to first talk about the inflation trends. We expect the inflation to be on the increasing trend until last quarter of the year because mainly on the because of the rise in commodity prices and producer prices. Latest figures showed us that we are close to 40% in terms of the annual rise in producer prices. With the reopening of the economy, it means that a part of this rise will be passed on to the consumers in the upcoming period. So we can see the annual inflation to getting close to 19%. Then, because of the base effect in the last quarter, we will see the inflation to slightly decelerate. This may, this decline in the inflation rate can give an opportunity to the central bank to cut its rates, which currently stands at 19% because of the decline in inflation. But although the central bank opts for a cut in its policy rate, I wouldn't expect it to be a very wide rate cut. It can be something between 100 and 150 basis points, but that would be all because the high inflation dynamics.
Thank you, Seltem. Now we jump directly in Italy. So this question will be for Marcos. Several experts are revising Italy growth forecast upward. The restart, we are calling in Italy. This should be good news for our Italian companies. And the question is, are they higher risk of insolvency in some sector? Do you feel some risk coming up?
Yes. So first, on the topic of GDP, I think that the general consensus points to a rebound anywhere between 4.5%, 5.5%. Some people say 6%. I actually revised it down, my GDP forecast for Italy slightly, but just because it's not because I think it will be doing worse in 2021. It's more because the GDP results for the first quarter were a little bit disappointing with regards to what we were expecting, notably because well, there were some lockdowns in Q1 that weren't factored in. But anyway, like these revisions are in their intensity, I think, a little bit marginal. The overall the overall perspective hasn't changed all that much. We have since the beginning of the year expected a pretty robust recovery starting in the summer. And so this is all obviously this is positive. The effect of the European funds is expected to starting to be felt in the second quarter as well. Like I mentioned briefly during the presentation. And so regarding the risk of insolvencies, there is something that I always like to be made very clear when I talk about insolvencies, is that especially with regards to timing, there is a big difference between credit risk and activity. So to make it simple, activity is getting better. Activity is expected to continue to get better 2021, 2022.
Yes.
But the situation in terms of insolvencies could actually get worse because the timing of the effect of last year's crisis on insolvencies has been very deferred. Some of it, a large amount of it, has been canceled because, as I said,
Yes.
government help has been very, very high, very powerful. I mean, honestly, if the reaction of governments have been anything like what we had in the '08 crisis, I think we would have seen 5 or 10 times as many insolvencies as in '08 because this crisis hit sectors where companies are very small, and there's a lot of them. But this wasn't the case. Help has been plentiful, and so insolvencies have been very low. Insolvencies have been very low. Now, with regards to, like I said, we expect to see a progressive catch up towards the end of 2021, going into 2022. Debt has increased. Obviously, the economy getting better means that for a lot of companies whose debt increased, cash will start flowing in, and cash is flowing in, and it might flow in at an intensity that is greater than in 2019, for instance. But still, some companies are in trouble. Where sectorally these might be concentrated, as far as we can tell, like I said, textiles is a difficult sector for reasons that are even unrelated to the pandemic, for more long-term structural reasons. It's hard for small textile, and this has been the case for many years, it's hard for small textile producers to be cost competitive in Europe. Furthermore, tourism, anything related to tourism, even if help was plentiful, there are bound to be some companies that have trouble there. Energy, especially not renewables, because renewables are getting a lot of subventions, but hydrocarbons, we know that in Italy there was some years ago in 2019 a moratorium passed on explorations of oil. So apologies if you hear a noise. I think my neighbor is doing like drilling or something.
No, we don't
Okay.
hear anything.
Okay. And weirdly enough, construction, because and here's where we see the difference between activity and solvency, because construction in terms of activity, like I said, it's set to do very well. But we also know that construction is, for structural reasons, a sector that where just a lot of companies tend to go bankrupt. There's a lot of creative destruction. And before the pandemic, there was already a lot of debt in the construction sector. So if you are in construction and you manage to get government sourcing contracts, if you're participating on the high-speed rail that is being built between Italy and France, if you're participating in the sector of renewing buildings to make them environmentally viable, all good for you. But watch out for the weaker companies in the construction sector. Also, automotive, like same thing that I said for Spain. If you are making parts for cars that are not renewable, that are not electric, and you've been facing difficulties in recent years, also watch out. And that's about it.
Thank you very much. Talking about risk, I go to Dominic now. Can you give a small outlook on South Africa, on the risk and what is going on in South Africa?
Well, as I said before during the presentation, Africa was particularly hit by the crisis because they enforced quite a stringent lockdown, and with lockdown there were a lot of restrictions to activity, and because of these restrictions, growth collapsed last year, and it is now recovering, but it is mild. This is a mild recovery because when the crisis hit, the country was already facing a lot of structural deficiencies, and these deficiencies are still there. I mean, they are still coping with these problems. And among these problems, I would like to mention the electricity supply problem with the EXCOM, which is a national, the state-owned company. You have a problem with governance, corruption in some circles. So the country is not out of the woods yet. It's not because the crisis is on the way to be overcome that it's going to be nice and fair in the country. The problems are still there.
Yeah, unfortunately, I will say. And Aroni, do you think China will participate in African debt restructuring process, or Dominic, who wanted to answer to this question?
Dominic, I'll let you. You're more specialist of debt than me.
Yes, thanks. Well, China is one of the main creditors for Africa because it lent a lot up to 5 years ago. In the last couple of years, it reduced its involvement in lending to Africa, but before it was lending a lot. So as a result, it is a big creditor, and sometimes it's the biggest creditors for some countries. I think yes, that China is willing to participate into the debt treatment, and it already showed its will to do it. It already agreed to restructure debts in some countries like Kenya, Angola, Congo, and I'm sure there are others. And it also, as a member of the G20 group of countries, it agreed to the DSSI initiative and also the common framework last fall. And well, it might not agree to apply the same conditions as other G20 members, but they agreed to the principle, and I think that's China's interest to get involved in the treatment of the debt, because if the debt goes fall in some countries, it's going to be a problem for China too. So they have to show some understanding for the countries, and they have to restructure. And sometimes they will have to erase some of the debts for these countries.
Thank you, Dominic. Regarding debts, now I jump to Europe. Should we worry about public debt in Eurozone, Marcos?
Sure. Before I treat that question, since we were talking about China before, I just have a little comment. It's something that really illustrates what I said earlier about the difference between activity and solvency in timing. As you guys know, China started its recovery in Q3 2020. So China has been growing and recovering for a long time before basically anyone else. Bond defaults, corporate bond defaults in China in the early 2021 are at the record highs. They're the highest they've ever been. So and I think this is like what I talked, like the deferred effect of the crisis is on corporate health. So it's not because you are getting super good in terms of activity that you're out of the woods in terms of solvency. On the question of corporate debt public debt in Europe, we are living in a very different world. We're living in a very different world versus the crisis of 2012, 2013. especially in terms of the attitudes of chiefs of state, ministries, economists, policymakers, the ECB, the European Commission, towards public debt. I think that what they have all interiorized is the fact that the thinking about public debt is very different in a world of very low interest rates versus a world of high interest rates, which was the world of before the global financial crisis. Because in a world of low interest rates, you can have a very high stock of public debt while being able to meet your regular repayment commitments fairly easily, because financing costs, because especially the refinancing cost of states are very low. And since now we have a world where the ECB is buying the public debt of governments left and right, where even the European Commission is now emitting debt on behalf of governments on a more significant scale. I think that there is a lot of trust from investors on the solvability, on the solvency of even the weaker states in terms of indebtedness in the eurozone, even of Italy, even of Greece, even of Portugal. Having said all of this, if you need to worry about public debt, to the extent that you need to worry, the threat is the rise of refinancing costs, which is not a likely threat right now. A rise in the interest rates is not a likely threat right now. Like I discussed earlier about inflation, the ECB is not going to restrict policy. Inflation is considered to be temporary, so they're not going to raise rates. They're not going to stop QE in any significant way anytime soon. If you were, it's conditional, durable high inflation, that would be a difficult situation, because then ECB would have to raise rates, and then we might see pressure on the sovereign risk premium, for instance, in Italy, and then we would be having these conversations if this is trouble. But we are not there yet. It's not clear that we will be there anytime soon.
Thank you very, very much.
And Antonella, could I say something about interest rates?
Yes, of course.
Yes, thank you. Well, I was thinking of interest rate in consideration with developing economies and emerging economies. The impact of a potential rise in interest would be different on these two categories of countries. It wouldn't be so bad for developing economies, because these economies mostly depend on public financing, like the IMF or bilateral financing, and this wouldn't be affected by interest rates. But it would be much worse for emerging economies, which rely more on markets, on financial markets. And in the case of a rise in interest rate, these emerging economies would be more impacted.
Thank you for
to be clear, Dominic, you're talking about the rise of interest rates of developed country central banks.
Yes.
Because of capital flows. Because so in case anybody doesn't have in their minds, when developed economy central banks raise interest rates, it becomes more interesting for you to invest your capital and your money in developed markets. And we know that developing and emerging countries, they rely on these hot global capital to finance themselves. And so what typically happens, as it happens in 2013, is that capital flows out of emerging countries very quickly to go back to developing markets. And especially with the Fed, that might be an issue, because since those guys are having higher inflation and higher fiscal stimulus, maybe in 2023, 2022, they have signaled that they might start restricting monetary policy.
Thank you. Very, very interesting in this exchange between super economies. Last, I will go with the last question, because we are going over the time, and this will be for CELTEM. we are interested on the health of Turkish companies, considering the high price of commodities and inflation risk. This is very key question, in my opinion.
Yes, because Turkey is a net importer of commodities. Of course, the rise in commodity prices, especially for companies that don't dispose natural hedge mechanism like exporter companies, it means that the price pressures, I mean, the production cost pressures will be on the rise in the rest of the year. Well, this become a problem for especially companies that is domestic demand oriented. But this won't be the only problem that the companies may suffer. Well, compared with the pandemic period, we can say that depending on the sector, of course, there are the companies have now better cash flow management. Of course, a part of it was supported by the loose credit conditions last year, and also the government initiatives that through credit mechanism that provided some sort of credit guarantee fund loans that allowed companies to use loans at a cheaper rate. But except that, with the reopening of the economy domestically, the companies from the retail sector and from the services will have a better opportunity to increase their turnover. That would help them to at least improve partly their cash flow management, but we don't expect the service sector companies to go back to their pre-pandemic financial situation very soon. So because usually in those sectors, once the company is not able to meet the instant demand, it means that the company has lost this demand. So it's not like the durable consumer product markets that consumers can opt to purchase, buy some stuff, not now but later. So once the services sector companies is losing the demand, then it will become very difficult to compensate this loss in turnover. That's why actually we don't consider that the comeback for the services sector would be a bit more difficult for the manufacturing companies that are always able to export. Well, however, there is some difference between the manufacturing services as well. For example, we are more optimistic for the countries operating in chemicals and metals, but we are more cautious for companies in the construction sector and energy because first of all they suffer from a loss of domestic demand, especially I'm talking about the residential segment of the construction sector. But for the energy sector, most of the companies have a huge burden of forex debt, so this creates a burden on their balance sheet, and so we hear a lot of restructuring of the loans in those sectors. So we will continue to stay cautious in the regarding these sectors because of the financial struggles of the companies operating in those two. However, with the increasing of the turnover in line with the vaccination efforts and reopenings, we can the financial situation of the companies for the rest of the sectors can improve. However, for Turkey, because of this import dependence in terms of inputs, the depreciation of the lira will be always will be always a struggle, and especially for companies that are not able to export, we can see a narrowing in profit margins, and also coupled with the increased production costs, we can see profits going down, and for especially those who are domestic demand driven, we can see a deterioration in cash flow management.
Well, we hope in the next webinar we can give more positive news for Turkey.
Well, actually, the situation, I can say that the situation has improved significantly since the pandemic period. But for some sector I mentioned, we keep our cautious stance. However, we are continuously reviewing our sector risk assessments, and since the last quarter, you can see in the last slide that there have been some improvement in our sector risk assessments regarding Turkey. Yeah.
Thank you.
Sertem, I have a question, if you don't mind. Don't you think that Turkey could benefit from the localization of a production process from Asia towards the more closest areas to Europe? I'm thinking about global value chains modifications, that some firm would repatriate some production from far away from Asia to the Mediterranean basin, and Turkey would be part of it.
Yeah, I definitely think it can, because the geographical localization of Turkey, it is very close to the European markets. Plus, Turkey's industrial tissue allows the manufacturers to diversify their production or their production volumes very quickly in terms of coming demand. So yes, I think that Turkey will be able to take a part of the orders placed to China before the pandemic. I think that Turkey can have a part of it.
Thank you. Just last question for Aroni. Very quick. Sorry. Positive word or the reality on risk on Africa. Thank you.
Well, for now, I'd say that the risks in Africa are tilted downwards, unfortunately, mainly because of the uncertainty regarding the pandemic, because the continent will only have access to herd immunity in late 2022 or 2023, so that's a long time from now. There is also a lot of political instability because, well, there already was, but there's also additional political instability because of the crisis. There are security tensions. The case of Mozambique is very telling with the Cabo Delgado province. There is an uncertainty in the recovery of tourism, and obviously, although the situation is much better in the advanced economies, there are still risks that there can be additional waves and variants, and all of this will affect Africa negatively. And obviously, I'll just end with the fact that there is obviously the problem of over-indebtedness, and that any reversion in the commodity prices or in the growth, the solid growth would be of enormous pressure, and some countries would frankly go into default. I think Zambia and Mozambique, if the situation reverses, they will default, and that will be major drags on their economy. I can end on a positive note though, because there are some countries in Africa where we are seeing some good developments, not only in terms of their growth, but also in terms of political perspective. A country like the Democratic Republic of Congo entered its first IMF agreement since a very long time, and things are changing over there. So in the midst of uncertainty, there are positive signals from some countries in Africa. So we can also say that it can also go the right way, if the health risks are maintained. So I will end on that.
Thank you very much. We are closing now the webinar. Thank you for participation again. You will receive the presentation and the recording version, and we invite you all to to follow us on social media. We are sending you flash news, economic publication to keep you posted on economy, and we wait all of you to the next webinar that will be September, October. Thank you very much, and thank you a lot to our economists.
Yeah, thanks to everyone who stayed for an hour and a half of economics. Not everyone has the patience.
Yes, thank you so much.
Thank you.
Yeah, thank you. Have a
Thank you,
nice
goodbye.
day. Bye-bye.
Bye-bye.
Bye.